If you own gold or silver, then the next 10 days could be more important than they look right now. Gold is trading near historic levels even after a sharp correction from its January peak. Silver remains one of the most volatile assets in the entire metals market. And now, investors are looking directly toward the Federal Reserve and the Jackson Hole Economic Symposium. The event runs from August 27 through August 29. The theme this year is financial innovation and its implications for payments and policy. That means August 29 is not an FOMC decision day, but it is the final day of one of the most closely watched central banking events of the year. And that distinction matters, because the market is not waiting for the Fed to actually change rates on August 29th. Investors are trying to determine what the Fed could do next. That is why gold and silver are moving with every major signal from interest rates and the bond market. As we speak, gold has been showing signs of recovery after a major sell-off. Reuters reported that spot gold rose about 0.6% on Wednesday as Treasury yields eased. At the same time, traders were waiting for the minutes from the Federal Reserve meeting held in July. Silver was more subdued during the same session. So the real story is not simply that gold and silver are rising. The real story is that the market is preparing for a major policy test, and that test could become clearer around Jackson Hole. The Federal Reserve has already given investors a complicated message. At its July 28th and 29th meeting, the Fed kept the federal funds target range at 3.5% to 3.75%. The decision passed by a 9-3 vote. 3 officials wanted a quarter-point rate increase instead. The Fed also said inflation remains elevated compared with its 2% goal. That is not a normal setup. The Fed is dealing with inflation that has not completely disappeared. At the same time, markets are watching economic growth and employment. The Fed says economic activity is expanding at a solid pace. It also says uncertainty remains elevated. The central bank specifically pointed to the conflict in the Middle East as one source of that uncertainty. This creates a difficult problem for policymakers. If the Fed keeps rates high, then financial conditions remain restrictive. That can support the dollar. It can also keep Treasury yields elevated. Both factors can create pressure on gold and silver. But if the Fed becomes more concerned about economic weakness, then rate cut expectations can increase. That can weaken the dollar. It can push yields lower, and that can create a powerful tailwind for precious metals. This is why the next major move may not be about what the Fed does today. It may be about what investors think the Fed will do next. That is where August 29th becomes interesting. Jackson Hole has a long history of being a place where central bankers communicate major policy ideas. The event brings together central bankers and policymakers from around the world. It also attracts economists and financial market participants. The 2026 event begins on August 27th and ends on August 29th. So when investors say August 29 could change everything, they are really talking about the information and policy signals surrounding the event. They are not talking about a scheduled FOMC rate decision on that date. The next scheduled FOMC meeting is September 15th and 16th. That meeting is associated with new economic projections. This gives us an important timeline. Jackson Hole comes first. The September Fed meeting comes later. Markets will use Jackson Hole to adjust their expectations for September. That means gold and silver could react before the Fed ever announces another rate decision. This is exactly how financial markets work. Markets price expectations. They do not wait for certainty, and precious metals are especially sensitive to those expectations. Gold has already shown how powerful this relationship can be. On August 18th, gold suffered a major decline as global bond markets sold off and Treasury yields jumped. Gold futures fell more than 1% that day. Silver dropped more than 3%. Then on August 19th, gold began recovering as yields eased. That is a perfect example of why investors need to watch the bond market. A gold chart can look confusing if you only look at the metal. The bond market often explains what is happening underneath. When yields rise sharply, gold can struggle. When yields fall, gold can recover. The relationship is not perfect, but it is extremely important. And silver can be even more sensitive because silver has a large industrial component. Silver is not simply a monetary metal, it is also an industrial metal. That makes its behavior more complicated. Gold mainly responds to monetary conditions and investor demand for a store of value. Silver responds to those forces too. But silver also responds to manufacturing. It responds to electronics, it responds to solar technology, it responds to electrical infrastructure, it responds to industrial activity. That means silver can sometimes outperform gold when economic growth expectations improve, but it can also suffer more during a major economic slowdown. This is why the next move in silver could be much more dramatic than the next move in gold. The market is currently balancing two very different forces. One force is monetary uncertainty, the other force is industrial demand, and both are extremely important. Now think about inflation. The Fed has made it clear that inflation remains above its 2% objective. That creates a problem. If inflation stays elevated, then the Fed has less room to cut rates aggressively. But if the economy begins weakening, then keeping rates too high becomes risky. The central bank has to choose the right balance. That balance can change quickly. A single inflation report can change expectations. A weak employment report can change expectations. A strong wage report can change expectations. A sudden move in oil prices can change inflation expectations, and geopolitical developments can change the entire picture. That is why gold and silver investors cannot focus on one indicator. The market is watching a complete chain of events. Inflation affects Fed policy. Fed policy affects Treasury yields. Yields affect the dollar. The dollar affects precious metals. And economic growth affects industrial demand for silver. That chain is what investors need to understand. Now there is another major factor: the US dollar. Gold and silver are priced internationally in US dollars. When the dollar strengthens, precious metals can become more expensive for buyers using other currencies. That can reduce demand at the margin. When the dollar weakens, metals can become more attractive internationally. This can support prices. But again, the relationship is not absolute. A geopolitical shock can send gold higher even while the dollar rises. A major supply problem can push silver higher even when the dollar is strong. And strong industrial demand can overpower currency effects. So the dollar is one part of the story. It is not the entire story. The same is true for interest rates. Higher rates are generally a headwind for precious metals. Lower rates are generally supportive, but investors care about real rates and expectations. If inflation remains high, then nominal rates can be high without creating equally attractive real returns. That is one reason gold can remain attractive during inflation uncertainty. Gold does not need to pay interest to remain useful. Its value comes from its role as a monetary asset and a store of value. Silver has that monetary connection too, but silver adds industrial demand to the equation. That creates an interesting setup. If investors become more confident that the Fed will eventually ease policy, then gold can benefit. If industrial activity remains strong at the same time, then silver can potentially benefit even more. This is why the gold to silver relationship deserves attention. When silver begins outperforming gold, it can signal that investors are moving toward higher beta exposure inside the precious metals sector. Silver usually moves faster than gold in both directions. That is the opportunity. It is also the risk. A strong silver rally can become extremely powerful, but a sharp reversal can happen just as quickly. This is why silver investors need to understand volatility. Silver is not a slow-moving asset. It can move several percent in a short period. It can break through major resistance levels. It can also fall through support levels with surprising speed. That makes the next phase especially important. Gold is currently acting as the more defensive metal. Silver is the more aggressive metal. If gold continues stabilizing while silver starts gaining momentum, then the precious metals market could be entering a stronger risk-on phase. But if gold weakens sharply while silver falls faster, then investors may be reducing exposure to the entire metals complex. That is the signal to watch. Now let's look at the current market context. On August 19th, gold was trading around the mid-$4,300 area depending on the market and timing. Reuters reported spot gold at about $43.59 per ounce during Wednesday trading. Silver was trading near the low $60 area. Recent market data showed silver around $63 during early trading. These levels are important because they show just how far both metals have moved from their earlier highs. Gold reached a record above $5,300 earlier this year. Silver reached above $115 earlier this year. Both metals have since experienced significant corrections. That means the market is not starting from a quiet base. It is starting from an extremely volatile year. Investors have already seen massive upside. They have also seen massive downside. That creates a very emotional market. Some investors believe the correction is an opportunity. Others believe the previous highs were unsustainable. The Fed will play a major role in determining which side gains control. That is why Jackson Hole matters. The market wants clarity. Will the Fed remain focused on inflation? Will policymakers become more concerned about economic growth? Will officials signal that rates need to stay restrictive for longer? Will they acknowledge growing downside risks? The answers may not be simple, but even a change in tone can move markets. This is one reason financial markets pay so much attention to central bank speeches. A central bank does not always need to announce a rate change. Sometimes words are enough. A single sentence can change expectations. Expectations can change bond yields. Bond yields can change the dollar, and the dollar can move gold and silver. This chain can happen within minutes. That is why investors should not wait for a formal Fed decision before paying attention. The market may already be moving. Now consider what happens if the Fed becomes more dovish. Suppose policymakers indicate that the balance of risks is shifting. Suppose investors begin expecting a September rate cut. Treasury yields could fall, the dollar could weaken, gold could receive a strong boost, silver could follow. And if silver begins outperforming gold, then momentum traders could become more active. That could create another wave of buying. But there is an opposite scenario. Suppose Fed officials emphasize that inflation is still too high. Suppose they warn that rate cuts are not guaranteed. Suppose Treasury yields rise again. Suppose the dollar strengthens. Gold could come under pressure. Silver could experience an even larger decline because of its higher volatility. That is the risk investors need to understand. There is also a third scenario. The Fed could remain deliberately vague. This is perhaps the most interesting outcome. If policymakers avoid giving the market a clear signal, then volatility could remain high. Investors would continue studying economic data. The market would wait for the September meeting, gold could trade sideways, silver could remain volatile, and every new economic report could create another major move. That scenario would not necessarily be bearish. It could simply mean the market needs more information, and that is why patience matters. The most dangerous mistake in a volatile market is believing that every move is the beginning of a huge trend. Sometimes a breakout is real, sometimes it is a false breakout, sometimes a correction is temporary, sometimes it becomes a larger trend reversal. The only way to know is to watch how price behaves after the initial move. That is where technical analysis becomes useful. Gold investors should watch major support levels. They should watch previous highs. They should watch moving averages. They should watch momentum. They should watch volume. Silver investors should do the same, but the most important technical signal may be relative strength. If gold rises while silver remains weak, then investors may still prefer safety. If gold rises and silver rises faster, then risk appetite may be returning. If silver rises while gold remains flat, then the market may be rotating toward higher beta metals. That would be an important signal. Now consider the broader economic picture. The Federal Reserve says economic activity is expanding at a solid pace. It also says inflation remains elevated. That creates an unusual environment. The economy is not clearly collapsing, but inflation is not fully defeated. This means the Fed cannot simply promise aggressive easing. At the same time, 3 FOMC members wanted a rate increase at the July meeting. That shows how divided the policy debate has become. This division matters. It means the next policy signal could be interpreted in very different ways. Some investors may focus on inflation, others may focus on growth, others may focus on labor conditions, others may focus on financial stability. And precious metals can react to all of these narratives. There is also the geopolitical factor. The Fed has already referenced uncertainty linked partly to conflict in the Middle East. Oil prices can affect inflation, energy prices can affect consumer prices, and geopolitical risk can increase demand for safe haven assets. Gold traditionally benefits the most from this environment. Silver can benefit too. But silver also depends on industrial activity. That means a prolonged geopolitical shock can create conflicting forces. Safe haven demand can push silver higher, but weaker global growth can pull industrial demand lower. That is another reason silver can be so volatile. Now let's talk about central bank buying. Central banks have become an important part of the gold story. When central banks accumulate gold, they create structural demand. That demand does not disappear simply because a short-term trader sells futures. It can help create a longer-term foundation for gold. Silver is different. Central banks do not hold silver in the same way. Silver demand comes more heavily from industry investors and physical buyers. That is why silver needs a different analysis. You cannot simply copy a gold forecast and apply it to silver. Silver has its own fundamentals. One of the biggest is supply. Mining supply can take years to respond. A new mine requires exploration. It requires capital. It requires permits. It requires construction. It requires workers. It requires infrastructure. That means a sudden increase in demand can create a supply problem long before new production arrives. This is one reason silver can experience explosive moves. When inventories become tight, the market can react aggressively. But investors should not assume that every shortage headline means a permanent shortage. Markets adapt. Higher prices can encourage recycling. Higher prices can encourage new production. Manufacturers can attempt to reduce the amount of silver used per product. Technology can create substitutes. The market is constantly adjusting. That is why the long-term silver thesis is powerful but never guaranteed. The next 10 days are about expectations. The next few months are about monetary policy. The next few years are about structural demand and supply. These are three different time frames. Investors should keep them separate. If you are watching August 29th, then focus on the policy message. If you are watching September, then focus on the FOMC. If you are watching the next few years, then focus on industrial demand and supply. That framework can prevent emotional decisions. Now here is the biggest point I want you to remember. August 29th is not a scheduled Fed rate decision. The next FOMC meeting is September 15th and 16th. But August 27 through August 29 is the 2026 Jackson Hole Symposium. That event can influence expectations for what happens next. So the headline should not be that the Fed will change rates on August 29th. The real story is that investors may get new clues about the policy path before the September meeting. Those clues could move gold, they could move silver, they could move treasury yields, and they could move the dollar. That is the real August 29th alert. If the message is dovish, then precious metals could receive another wave of attention. If the message is hawkish, then metals could face another test. If the message is neutral, then the market could remain trapped between inflation concerns and growth concerns. Any of those outcomes is possible, and that uncertainty is exactly what makes this market so interesting. So if you own gold or silver, do not just watch the price. Watch the Fed, watch Treasury yields, watch the dollar, watch inflation, watch employment, watch geopolitical developments, and watch the relationship between gold and silver. Those signals can tell you much more than a single headline. The market is already showing that it can reverse quickly. Gold dropped sharply during the bond sell-off. Then it recovered as yields eased. Silver experienced an even larger move. That tells us volatility is still extremely high. This is not a calm market. It is a market waiting for information. And the next major information event is getting closer. The most important thing you can do is avoid assuming that the next move is guaranteed. Gold could break higher, silver could explode higher, but both could also experience another correction. The key is confirmation. If yields fall and the dollar weakens, while gold holds support, then the bullish case becomes stronger. If silver begins outperforming gold at the same time, then the signal becomes even stronger. But if yields rise and the dollar strengthens while metals break major support, then the bullish setup becomes weaker. That is the framework. It is simple. It is practical, and it keeps emotion out of the decision. The precious metals market has already delivered huge moves this year. Now investors are waiting for the next catalyst. The Federal Reserve could provide that catalyst. The Jackson Hole Symposium could shape expectations. The September FOMC meeting could deliver the actual policy decision. And between now and then, every major economic report could move the market. So keep your eyes open, because the next big gold and silver move may begin before most investors realize it. If you believe the Fed will eventually become more supportive of precious metals, then tell me in the comments. If you think inflation will force the Fed to keep rates higher for longer, then tell me that too. And if you think silver can outperform gold once monetary conditions loosen, then I want to hear your view. This is exactly why the conversation matters. There is no guaranteed outcome. There is only data. There are expectations, there are risks, and there are opportunities. Gold remains one of the world's most important monetary assets. Silver remains one of the world's most important industrial and precious metals. Both are entering a critical period. The next few days could create volatility. The next few weeks could create a new trend. And the next few months could determine whether this year's correction was simply a pause or the beginning of a much larger change. So stay alert. Watch the bond market. Watch the Federal Reserve. Watch Jackson Hole. Watch the dollar. Watch inflation. And most importantly, watch how gold and silver respond to the news. Because sometimes the most important signal is not what policymakers say. It is how the market reacts after they say it. If gold rises on a hawkish message, then buyers may be stronger than expected. If silver rises even faster, then the market could be shifting toward risk appetite. If both metals fall sharply, then investors may be telling us that yields and the dollar still control the trend. That reaction will matter, and that is what we will be watching here at Silver and Gold Watch. If you found this analysis useful, then make sure you like this video, subscribe to Silver and Gold Watch for more gold and silver market updates, turn on notifications so you do not miss the next major market alert, and leave your prediction in the comments. Where do you think gold will be after Jackson Hole? Where do you think silver will be? And do you think the Federal Reserve will become more supportive or more restrictive? The next major move is coming. The question is whether the market has already started preparing for it. Stay informed, stay patient, and keep watching the metals. Because August 29th may not be the day the Fed changes interest rates, but it could be a day when investors learn something important about what comes next.